There is a particular kind of silence that settles over a trading floor just before something breaks. Not the calm kind, the kind that comes from miscalculation, from 1,000 intelligent people having made the same error at the same time for the same reason and not yet knowing it. I have been in this business for over 5 decades. I watched that silence arrive in 1990, in 2000, in 2008, and in quieter, less publicized moments scattered across the years between. And the remarkable thing, the thing that still catches me off guard, though maybe it shouldn't, is that the people sitting in those rooms were not fools, not reckless gamblers or uninformed speculators. They were sophisticated professionals with degrees from the right universities, experience at the right firms, and access to the same information as everyone else. That last part is the key. The same information as everyone else. Today, I want to examine 4 mistakes that do not belong exclusively to the amateur. They belong with equal ferocity to the expert. The distinction matters because most investment education targets the beginner, teaching people what to do. But the errors I want to discuss are not errors of ignorance, they are errors of pattern. Psychology dressed up in the language of analysis. The mistakes that experts make precisely because they have become expert, because experience in certain configurations doesn't protect you from error. It manufactures it. Let us begin with the first. Mistake no one. Mistaking the absence of risk for the absence of danger. There is a concept I think about often, what I have come to call the paradox of invisible risk. The most dangerous moment in any investment cycle is not when risk is visible. It is when risk has become invisible, when it has been priced out of existence by collective confidence, when the instruments that are supposed to measure danger are themselves contaminated by the very optimism they are meant to assess. In practice, it works like this. When markets are rising steadily, when defaults are low, when volatility has been suppressed long enough that people have stopped fearing it, risk doesn't disappear. It migrates. It moves from where it can be seen, weighed, and compensated for into the structures beneath the surface, into the assumptions built into every model, into the behavior of investors who have slowly, quietly, without announcement, begun taking more risk than they realize. Think of a pressure system. When barometric pressure drops ahead of a storm, the air doesn't feel different. You cannot smell it or see it or hear it. But the conditions for destruction are assembling out of sight, and the calm itself, the absence of any warning signal, is the warning signal. In 2006 and 2007, credit spreads were extraordinarily tight, translated from market language into plain English. Investors were accepting very little additional return for taking on very significant additional risk. They had looked at several years of low defaults and concluded that the world had somehow become permanently safer. That the credit cycle, a feature of capitalism for as long as capitalism has existed, had been canceled. It had not been canceled, it had been delayed. And delays in financial markets tend to collect interest. The expert's version of this mistake is subtler than the amateur's and therefore more dangerous. The amateur avoids risk because it frightens him. The expert, having navigated several cycles successfully, starts to believe he can identify risk reliably, and so the absence of visible risk feels like genuine safety. His competence becomes a liability. He has learned to read the instruments. What he hasn't learned is that the instruments themselves can lie. The right mental posture here is not fearlessness. It is calibrated suspicion. When assets feel safe because they have been rising for a long time, that feeling is a symptom, not a diagnosis. True risk assessment is not about how an asset has performed. It is about the gap between its price and its underlying value and the margin of error embedded in that gap. When that margin is thin, when there is no room for the unexpected, no cushion for the improbable, the asset is dangerous, regardless of how it looks on the surface. Risk is not measured by recent performance. It is measured by what has been assumed in order to justify the current price. And what gets assumed during long periods of calm is always the same thing, that the calm will continue. Mistake. No. 2, treating consensus as information. Most people, when they make an investment decision, gather information, analyze it, and form a conclusion. If the information is good and the analysis is sound, they assume the conclusion will be profitable. This is reasonable. It is also insufficient. The question they forget to ask, if this conclusion is obvious to me, how many other people have already reached it? This is the foundation of what I call second level thinking. And it is where the gap between intelligent amateurs and genuinely superior investors widens most dramatically. The first level of thinking produces the right answer to the wrong question. It asks, is this a good company? Is this economy growing? Is this asset undervalued? Second level thinking asks something harder. What does the consensus already believe about this company, this economy, this asset? And is the consensus right or wrong? The structurally important insight, uncomfortable as it is that in liquid markets, the consensus view is almost always already reflected in the price. The information that everyone has is not an edge. It is furniture. It is already built into the number you see on the screen. The return you earn from an asset is not determined by whether good things happen. It is determined by whether better things happen than the market expected. This is why experts make this mistake too. They do the research, they build the model, they produce a conclusion that feels rigorous because it is rigorous. And then they pay a price that already reflects that conclusion, or worse, that reflects something even more optimistic, and they wonder why superior analysis did not produce superior returns. Insight alone is not the edge. The edge is insight that is not yet in the price. Think about what that means in practice. When the financial press is uniformly optimistic about a sector, when analysts are nearly unanimous in their buy recommendations, when the narrative around an asset has become so well established that it is the backdrop against which all other stories are told, that is precisely when the consensus is most completely baked into the price and therefore least likely to produce outperformance for anyone who holds it. A useful image: imagine a race in which the bookmakers have had weeks to adjust the odds. By race day, every piece of publicly available information about every horse training records, jockey, weather conditions, the track has been incorporated into the odds. If you bet on the favorite based on the same information that set those odds, you are not making an investment. You are making a wager at equilibrium. You can be entirely right about the horse and still lose money if the odds were already generous enough. Markets work the same way. The crowd, in aggregate, sets prices based on available information. If you hold a view based on the same information as the crowd, you have no edge over the crowd. To earn returns that differ from the crowd's, your analysis must differ from the crowd's not in quality alone, but in content. You must believe something about the future that the crowd does not yet believe. The expert's trap in this second mistake is particularly elegant. Expertise breeds confidence in analysis, and confidence in analysis breeds the assumption that being right about the underlying reality is sufficient. It is not. Being right about the reality is the price of admission. The profit comes from being right about what the market got wrong. And that requires not just understanding the asset, it requires understanding the crowd that prices it. Mistake number 3, confusing the cycle with the trend. Every financial era has a story, a narrative that feels, while you are inside it, not like a cycle, but like a transformation, not like a phase, but like a permanent new reality. The era of emerging market dominance, the era of tech disruption, the era of low rates forever, globalization as an irreversible fact of economic life. These narratives share a common structure. They take a trend that is real, extrapolate it forward without limit, and gradually strip away the qualifications and caveats until the extrapolation becomes an assumption. And the assumption eventually becomes the foundation of asset pricing. The pattern repeats because the underlying psychology repeats. Human beings are pattern recognition machines. We take recent experience and project it forward. This is useful in most of life. In markets where mean reversion is a structural feature of the landscape, it is catastrophic. I call this the error of trend theology, the moment when investors stop treating a trend as a temporary condition with a lifespan and begin treating it as a permanent feature of the universe. Expert investors are not immune. In some ways, they are more susceptible because they have the vocabulary to make the extrapolation sound rigorous. They can model it, present it in charts, defend it in front of boards and investment committees with the full weight of quantitative sophistication. And all of that sophistication is in service of a conclusion that amounts to, this time it is different. Those are, in my experience, the most expensive words in the English language. The cycle is not the enemy of the trend. They coexist. Long-term structural trends are real. Technology does change industries. Demographics do reshape economies. Policy does create new equilibria. But superimposed on every structural trend is the cycle of human psychology. Optimism builds, pushes prices beyond what the trend can justify. Reality asserts itself. Prices correct. Pessimism overshoots. And the whole process begins again. The expert who confuses the trend with the cycle understands the structural story, but forgets to ask what price that story is already embedded in. He buys a transformative technology company at 80 times earnings because the transformation is real, and then watches it fall 70%. Not because the transformation was wrong, but because the price was wrong. He was right about the world and wrong about the market, which is the most frustrating way to be wrong because it feels like being right. What the cycle demands of you is not skepticism about the trend, it is humility about the price. The discipline to ask, even if everything I believe about this story is true, what does the stock need to do for me to earn an adequate return from this price? If the answer requires a great deal to go right, if the margin for error is thin, if the assumptions embedded in the current valuation are already generous, then the position is dangerous regardless of the quality of the underlying story. The pendulum swings in the direction of the trend, and then it swings back. The people who forgot it was a pendulum and assumed it was an arrow pointing permanently in one direction are the ones who find themselves fully invested at the top of an arc they thought was a floor. Mistake number 4, overvaluing precision and undervaluing judgment. There is a final error, perhaps the most insidious of the 4, because it most directly exploits the tools of sophistication. I want to call it the illusion of the model, though the problem it describes is older than any spreadsheet. You have data, lots of it. Analytical frameworks, historical return series, volatility estimates, correlation matrices, scenario analyses, Monte Carlo simulations. You build a model that takes this information and produces a number, a precise, specific, defensible number. And that number becomes the anchor for your decision. You trust it not because it is right, but because it is specific, because it has decimal points, because it feels like the opposite of guessing. It is not the opposite of guessing. It is guessing with extra steps. And the extra steps are dangerous because they create an illusion of certainty that the underlying situation does not actually possess. This is where expert investors fail in a way amateurs cannot, because amateurs rarely have the tools to build the illusion. The amateur knows he is estimating. The expert forgets he is estimating because his estimates have been given the form of equations. Every financial model requires assumptions about growth rates, discount rates, terminal values, macroeconomic conditions, competitive dynamics, management quality, regulatory environments. Each of these assumptions is itself an estimate, and the model compounds them, multiplies them together in ways that can make a 10% error in one input translate into a 40 or 50% error in the output. The decimal points at the end of the calculation are not precision. They are the residue of compounded uncertainty presented in the costume of accuracy. Charlie Munger said it better than I could. I have no use whatsoever for projections or forecasts. They create an illusion of apparent precision. The more meticulous they are, the more concerned you should be. The correct antidote is not the abandonment of analysis. It is the cultivation of judgment alongside analysis and the willingness to let judgment override the model when the model's assumptions are not trustworthy. A great investor is not someone who builds better models than everyone else. He is someone who knows which models to trust and which to distrust, who recognizes when the inputs are speculative and responds by demanding a larger margin of safety rather than a more elaborate spreadsheet. This connects to something I have believed for most of my career. The goal is not to be precisely right. The goal is to be roughly right and appropriately humble, to understand the range of outcomes, to know where the distribution is fat-tailed, and to position yourself so that the worst cases within that range do not threaten your ability to continue. When models give precise answers to imprecise questions, they do not make the question more answerable. They make the answer more believable. And a believable wrong answer is more dangerous than an acknowledged uncertainty because it forecloses the mental flexibility that uncertainty, properly embraced, would have preserved. This is the fourth mistake. Not ignorance of the tools, but overtrust in them. Not the failure to quantify, but the failure to remember what quantification cannot do. The thread that runs through all four. I want to draw something out before we close because these four mistakes are not unrelated. They share a common ancestor. All four mistaking invisible risk for safety, treating consensus as information, confusing cycles with trends, and overvaluing precision over judgment are expressions of a single deeper failure. The failure to think about what other people are thinking and how that collective thinking has already shaped the landscape you are navigating. Risk becomes invisible because everyone has decided it is gone. Consensus fails because everyone holds it. Trends become theology because everyone has extended them. Models mislead because everyone is building and trusting similar ones. In each case, the error is not merely analytical, it is social. It is the failure to step outside the shared frame and ask, what does this crowd believe? Why do they believe it? And what happens to asset prices if they are wrong? Superior investing, not in every quarter, not in a straight line, but over time and across cycles, requires a kind of productive loneliness, a willingness to hold a view that is not corroborated by the consensus, the capacity to sit with the discomfort of being early, which is indistinguishable from the discomfort of being wrong, a recognition that crowd approval and analytical accuracy are, in markets, almost perfectly uncorrelated. This is not a counsel of contrarianism for its own sake. Being contrary is not the point. The point is the independence of thought that makes it possible to be contrary when the evidence warrants it, and conventional when the evidence warrants that. The aim is not to disagree with the consensus. The aim is to form your own view rigorously, humbly, with full awareness of what you do not know, and then act on it, regardless of whether the crowd is standing beside you or pointing and laughing. There is a phrase I return to often, almost like a compass check. We may not know where we are going, but we ought to know where we are. I cannot tell you what the market will do in the next 12 months. Neither can anyone else, regardless of what they charge you to hear their opinion. But I can tell you where we tend to be when certain conditions prevail, when spreads are thin, when leverage is easy, when pessimism has been absent long enough that people have stopped accounting for it. I can tell you what the historical distribution of outcomes looks like from positions like the one we find ourselves in now. And that knowledge, imprecise, probabilistic, genuinely humble, is more useful than any model pretending to certainty it does not possess. The four mistakes I have described today are not solved by smarter analysis. They are solved by clearer thinking about the nature of markets, about the fact that prices are set by human beings, that human beings travel in herds, that herds oscillate between confidence and fear, and that the price of an asset at any given moment is not a pure reflection of its value, but a complex function of that value and the collective psychology of every person trading it. When you understand that, the mistakes become visible before you make them. Not always, but often enough. The challenge I want to leave you with is specific, not a vague instruction to think differently or be contrarian. Those are slogans, and slogans are the enemy of clear thought. The next time you make an investment decision of any kind in any asset class, ask yourself one question before you act. Ask it seriously, in writing if you can. What does the consensus believe about this? And what would have to be true for the consensus to be wrong? If you cannot answer that, you are not yet ready to make the decision. Without knowing where the crowd stands, you cannot know whether your analysis is information or furniture. You cannot know whether you are discovering something or confirming something that has already been confirmed 1,000 times and priced accordingly. Write that question down, put it somewhere you will see it. Let it become the first thing you check, not the last. The pendulum will swing again. It always does. The 4 mistakes I have described are the ones that put you on the wrong side of it. Understanding them, really understanding them, not just nodding along, is what puts you on the right side. Not because you will always be right, but because you will be wrong less often, less severely, and with more residual capital to take advantage of the opportunities that error always creates. That is the only edge that endures. Not brilliance, not certainty, the quiet, disciplined, patient habit of thinking about your own thinking and asking every single time what you might be missing. That's all. Thanks for watching.